Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over some information we've got on Twitter. We'll go over some ratios. It looks like I didn't go over some of the ratios because I didn't go over the Baltic Dry Index. We'll go over the Baltic Dry Index together, see how cheap Baltic Dry Index is, which is it's incredibly cheap. And I'll give you my financial opinion as we go through all this. So again, if you need any help with anything commodity related right now, that's where I'm focusing on. It's finding-value.com. We've got a platinum membership. I know some people ask, well, why do I have 9999 under the silver membership? Because I'm going to eventually get rid of the silver membership. I just don't think enough value is there being added like the platinum membership. So that will eventually be phased out over time. All right, so let's dive in. And if you guys want to follow me on Twitter, it's at finding_finance. I do post on here regularly. So this guy posts, he says, biggest market puzzles. If global growth is so strong, why are oil prices flat? Why no China reopening lift to commodity prices? Why are yield curves inverted if there's no recession? Why do so many people want to be long the euro? Why has Fed pivot not lifted S&P 500? I think that's kind of short-sighted. It's because I wanted to just share this so I could give my opinions on it during this clip. If global growth is so strong, why are oil prices flat? Oil prices are not related to growth. Oil prices are related to the money supply and how much credit is being driven into the system. Now, one could say that growth and credit are synonymous to some extent, but I don't think they are. You could have GDP growth and oil prices flat, like all of 2009 all the way till 2020, where oil prices were pretty stable. I mean, they went up a little bit in the early 2010s to the mid 2010s, but they were pretty stable for the most part. Credit growth under an expansionary phase of real estate is what drives oil prices because the expansion of the money supply. The expansion of the money supply and the mismatch between credit growth and GDP growth is what drives oil prices and the rotation of money. The problem is things don't go up in a straight line. They go up in waves. And you can have the right conditions and the prices can remain flat, like he's saying. Why are oil prices flat? Because it takes time to digest moves and things don't go up in a straight line. So you don't have a direct correlation when global growth goes up and down. Things aren't immediate. It depends on the cycles of oil increasing or decreasing its production and output. Things don't happen immediately. So in markets, there's going to be a lot of times where things are delayed or where things overshoot and they don't exactly mimic something that has a direct feedback that is instantaneous. So to even say this, to say something like this, it doesn't mean, I mean, it's almost like this person doesn't understand the markets. And I don't know who this person is, but it says, why no China reopening lift to commodity prices? Because it's not instantaneous. It takes time and it takes traction and it takes the virus to basically go through the entire system and kind of work its way out. That might take 6 months to a year for the reopening to be fully felt. And if there was downward momentum, it takes time for that momentum to work its way up to the upside. So China reopening, I know people say, oh, it's open now. I should see prices instantaneously shoot higher. And it's like, guys, this may take 6 months for everything to kind of, we'll say, change the paradigm and change the psychology of investors, number one, where money flows start to change differently, where you'll see oil prices start to move up. You'll see commodity prices start to move up. You're going to have to see inventories work its way down. It just takes time. And I think that's one of the biggest downfalls of investors is they think things will happen instantaneously. It doesn't. The markets are really slow and they take long to move, which is great because it gives you extra buying opportunities in the markets. And they also move in waves. It doesn't move straight up. It doesn't move straight down. It says, why are yield curves inverted if there's no recession? Well, I could maybe throw something out, and I don't know if there's going to be a recession or not. Stimulus money and QE in 2020 caused a gigantic credit orgy, we'll call it, which pushed all these commodity prices, pushed everything higher. At some point, you're going to have an overhang or a hangover from that stimulus in the system. And it will have to move rates, and the amount of credit expansion will have to move to a more sustainable rate in the system, wherever that is, because we've had outside pressures jacking around with putting assets on balance sheets. They were creating money and handing stimulus money out to people, and they did QE to hold interest rates down. Where in history can I point to say that that's happened before? You can't. There's no other time in history that they've done all of the manipulation in the markets as heavily as they did. And it usually takes about 18 months to 24 months to work its way out of the system. And that's what's happening. It's taking that amount of time to fully work its way out of the system. So we're if global growth is so strong, why are oil prices flat and why is commodity prices flat? China's reopening, yes, but we're also getting a hangover from the stimulus money. Now, the question that I ask is, when we get this hangover from the stimulus money and QE that they did and all this other garbage of putting assets on balance sheets and all that, what's it going to look like after? Is the market structurally strong, but we're looking at an inverted yield curve from all of that stimulus that went into the system? If the market is strong, but we're just coming off a stimulus hangover, maybe we don't have a very big recession. Maybe it's a small one. Maybe it isn't. No one really knows because no one's seen this in history before of all this stimulus money. So to come out and say, well, why are yield curves inverted? I mean, guys, all of our indicators are also jacked up because they were playing with the stimulus, the QE, and the asset, putting assets on their balance sheet and all this other stuff. The money's in the system. It's over in financial stocks and bonds. It's over in financial products, so to speak. But that money's going to have to rotate over if interest rates are going to go up. And interest rates going up partially is from the stimulus money coming into the system and the QE, because it created all that inflation. And maybe we have interest rates go back down for a little bit, because that could end the first wave into a second wave. It'll end the second wave on the pullback, and then we go into a gigantic third wave. Because structurally, there's inflation in the system driven by the demographics. And why is the Fed pivot not lifted? They haven't pivoted yet. So I don't know why that they're still raising rates. It's just at a lower rate. So I think a lot of this is just, I don't know. Wanted to comment on it. Here's today. More than ever, I think charting is our only real edge. There are simply too many parameters nowadays for anyone to get macro analysis consistently right. Also think many established macro correlations will change going forward, and charting reveals the coming narrative. I completely agree with that. Charting is the unbiased approach to see kind of how the markets are doing. And there are a lot of things with stopping economies they stopped the Chinese economy. They stopped our economy for a little bit in 2020. They did QE. They're doing QE around the world. They're printing money. They're putting things on asset balance sheets. They're doing all this stuff. And it's like, man, this is really hard to get the macro analysis consistently right. I completely agree with what he's saying there. And charts and seeing how people are positioning and seeing the patterns, I think, is how you can kind of bypass all of the, we'll say, the difficult readings and the indicators and see what's actually going on. Now, I don't think everyone or anyone's not going to get this all right. There's going to be things and things that you mess up. The way that you protect yourself from that is to make sure that you're in the undervalued assets and that you're continually giving yourself a large margin of safety of value, of buying stuff that's out of favor. And that's really the only thing that you can do. I'm not here trying to predict the future. A lot of people try to predict the future, and all I've seen from them is them consistently getting it wrong, trying to call for crashes every year, and getting it wrong every year for the most part. A lot of these people. It says, imagine the smell of the SPY, and what he has here is he's got that the chart. This is the cycle basically, and what this cycle is, if you were to break it up, this here is the expansion phase of real estate. This was the top for commodities. Then we went into a sell everything event where the commodity market crashed and the housing market crashed all at the same time. Everything crashed here. That's the great financial crisis. We went into a recovery phase of real estate, which is from here to here for the most part. And then when we go into a expansionary phase of real estate, this starts to pull back because they increase interest rates and it reprices assets differently. That's the top. And I do agree, this is probably what it's going to do. This is the S&P 500. So it's probably going to pull back. It's going to make a double top. This top could be up here. It could even go a little bit higher. It could be a little bit lower. We don't know exactly where this will top out, but this is probably the bull trap. And then we're going to get a stronger sell-off. The question that you have to ask yourself is, where does the stronger sell-off come from? That is the question that you must ask yourself, because that is the most important thing. If this sell-off comes from increasing interest rates, then that means we're in an inflationary period. We're in an expansionary phase of real estate and commodities will go higher. If we get the sell-off from the interest rates remaining high or going higher. If this is a sell everything event, that means it's coming from the housing market. If it's coming from the housing market, we should be able to see it. Problem is, the housing market doesn't have a lot of inventory. It is cooling off. And if it's being driven by interest rates, then there's inflation in the system somehow. And it's coming from somewhere. I don't know how they can increase interest rates and not have the inflation be present. I don't know if they can do that. Now, if they lower rates, I think it'll kick back on the housing market. Now, that's me speculating there, but I think that's the case. And that's where if you lower the interest rates, it kicks back on the housing market. That is inflationary. So it's going to have an inflationary component if interest rates dip down and the mortgage rates dip down for the housing market. And that's my opinion there. Doesn't mean every single city goes up. Doesn't mean that every single area goes up. It just means that overall, I think we'll get inflation in the United States from a robust housing market and robust demand for a period of time if interest rates were to go back down. The lever here is interest rates. It really is. The affordability and the way that they increase that up has slowed down inflation coming into the system from the real estate market. But this does look like it potentially could be it. I don't know for sure. No one knows for sure, but it could potentially work out that way. Here's one. It says China is starting to pull hard on their crude stocks, which is in line with the reopening and demand picking up domestically. Also, with the news of lower product exports going forward as Jan demand was stronger than expected. And you can see in 2023's the red, we're starting to pull down. They are Chinese stocks. That's their inventory. So they are pulling down on their inventory. And remember, they're just reopening. There's a lot of people catching COVID over there. And things are obviously going to be a slow reopening. But they're pulling down on inventory, and that's what we're going to watch and see. I do have a video with Trader Ferg. It's a good one. Brandon Monroe, CEO of Bannerman, says wind turbine costs are up 25% in a year. The public has been promised renewable energy is getting cheaper, and that is without considering the increase in system costs. Voters are understanding that nuclear energy must play a greater role. And this is the side. It says it reports that onshore turbine orders dropped 46% year on year in the last quarter, and the cost of those turbines went up 25%. So when I was talking about this in solar and in wind, I said there's a large correlation between their costs and the costs of commodities themselves. And what I stated was if the cost of commodities increase and the cost of energy increases, the cost of renewables is going to go up. And I know a lot of people they've been pushing Moore's law and all this other stuff. That's a farce, because if that was the case, then the cost would be dropping faster than the commodities prices. And that was not the case. They look almost identical when I had charted that before, stating that the commodity costs are what are bringing down the wind turbine costs and solar. And it looks like that I was right, that commodities are a large driver of the cost of these things. And it only makes sense because these are gigantic, especially wind turbines. They're gigantic amounts of commodities that go into that. And if the price of those commodities go up, it just makes sense that the price of wind turbines would go up as well. Here's the SPX versus uranium ETF, URA. It says, how I see it is it's possible underperformance of SPX versus URA over the coming years. It's a massive head and shoulders with a target just north of a 4 ratio. A 4 ratio, we're way up here at maybe about 16 or something like that. And then we are going to be heading towards 4 potentially, depending on that target. I would argue that it's going to go below that. The reason I would say it goes below is the head is projected off the neckline, and usually, I mean, that would project it way down here, something negative even. But that's URA versus or SPX versus URA, and I do think that we'll break to the downside eventually. Eventually. I went on Palisades. You can check me out there. You can see what I have. I talked about cheap energy and systemic inflation going forward. And it doesn't mean it goes straight higher. It's going to be in waves. Here's one. It says, hard to believe the labor cost pressure will subside anytime soon with job openings at these levels. The ratio between job openings and unemployed people remains at 2 times today, near all-time highs. Wage growth likely to remain stubbornly high, a structural inflationary driver. Agreed. And here we are heading higher above previous ones in the early 2000s. So there's going to be some wage growth going on. It's probably a great time to be looking for a job if you want to switch careers or switch jobs in the same career. I also said I'd go over the Baltic Dry Index. So let's go over the Baltic Dry Index. These are ratios here. You can see the Baltic Dry Index. What I did here is we've got kind of a wedge type formation that was formed here. And we broke out to the top, broke out again, and then we fell down and broke below it. And we've been in a very cheap, this is incredibly cheap area. And we're basically right at the bottom of the ratio, scraping along the bottom for the Baltic Dry Index against gold. And looking at previous bull markets, this is a gigantic bull market all the way up. It peaked out at 14. We are at approximately 0. One's up here, which means the Baltic Dry Index, in terms of its relationship to money in the system or the price of gold, is incredibly cheap, which means there's opportunities there for the patient long-term investor. If we look at Baltic Dry Index to crude oil, that is also incredibly cheap. And there is a component where Baltic Dry Index is tied to crude oil. They kind of move together. And you can see the outperformance in the middle of the last bull market for Baltic Dry Index. So if we were to kind of use this ratio, it looks like there's some sort of megaphone that is developing, and we are at the bottom of that megaphone, which means we could see an outperformance to the upside for the patient investor. I say patient because it could stay down for a little bit. And then the Baltic Dry Index against copper, all-time lows. And we're seeing another kind of, we'll call it wedge formation or megaphone pattern that, I should say a megaphone pattern that is developing. So I just want to cover that. I know some people are talking about Baltic Dry Index. It is super cheap. Baltic Dry Index is probably a spot that I would be looking. I do own a couple of shipping companies, and I think it hopefully will do very well going in the future. And the narrative, if you were to drive a narrative, all right, Baltic Dry Index, that's shipping minerals around the world, coal, metals, agricultural stuff, all that stuff. If we want to go to a renewable route, you have to ship more things. It's 16 times more mineral intensive, which means you got to ship more minerals if you want a renewable world ahead of us and electric vehicles and all these other things. So if it's more minerals need to be shipped, the choke point could be shipping. And the choke point, if it's all choked up, that means the Baltic Dry Index pricing would go higher. But in the short term, it is going lower. They had the Chinese lockdowns and all that other stuff. It's going to take time for things to catch back up. And there's your opportunity. That's one of the opportunities. But that's what I've got for today, guys. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't. And we'll catch you next time. This is Finding Value.